gentlemen, Graeme Holm here, aka Australia's original money mentor, and it's an absolute pleasure as always each week to introduce you to the brilliant Dr. Andrew Wilson. I won't cover off his credentials. Most of you by now should know who he is and the amount of weight, his accreditations and his experience. He's definitely well versed as a talking head in the industry, and his knowledge, his degrees, his accreditation cover all of that. So let's not muck around. Good morning, Doc.
Yes, good day, Graeme. Good to see you again, and happy end of spring selling season. Well, not really.
My voice is a little bit better, and the market's also a little bit better. So we've got a lot to talk about.
Yes, look, the market's a little bit better, but we've been saying that, I guess, every week, every month for the last few months, or particularly through spring. There's no doubt that now we've come to the end of spring, that we can look back and, I guess, assess just exactly what's happened. And there's no doubt that we've had a revival in our housing markets, really just about right across the board. Brisbane's probably slightly the underperformer, but it's been a top performer before that. So, and there are a few reasons why Brisbane's just treading water at the moment, particularly the reason that we're not seeing that surge in southern migration that drove the Brisbane market last year. So I guess it's in pause mode just in the short term. But international migrants are heading for Brisbane, as they are for everywhere else, particularly Melbourne and Sydney. So I wouldn't expect Brisbane to be sitting steady for too much longer. But there's no doubt that we've seen clear improvements over the spring period in all our housing markets, following what was obviously a very nervous winter period. We had interest rates rising for the first time in over 10 years, and we've had sharp increases in interest rates, almost unprecedented increases in interest rates through winter and into spring. But even with those sharp interest rate increases, markets really have to some degree taken it in their stride. Consumers have taken it in their stride. And I think the outlook for interest rates, Graeme, is improving now. And I think, as we've been discussing, that interest rates will peak lower and sooner than many have predicted. And we'll look at some of those signs going forward today. We now, I guess, in a sense, the market's ending now. We're moving into December, of course. Buyers and sellers become increasingly distracted with the forthcoming holiday period. We typically do see clearance rates in our weekend auction markets start to fall at the end of November and into December. And that's because of that sort of distraction factor. Buyers tend to think, well, let's wait till next year. And sellers therefore don't have the same pool of buyers to I guess, tap into the end of the year. So really November's the peak period of the market. And so we can look at those November results, and that gives us a sense of how our markets have travelled going forward, following, before we move now into that quieter December and obviously January period.
And before we start, Doc, there's been a bit of a low act, pardon the pun, in the media recently. Yes. We've had Mr. Philip Lowe, our beloved Reserve Bank governor, come out publicly and not back the decisions they made and actually apologise on camera.
Yes, quite extraordinary, Graeme, and unprecedented for the head of the Reserve Bank to I guess, have that conversation. I mean, we need to have confidence in the Reserve Bank. We don't need our Reserve Bank governor, apologising for policy positions and apologising for statements. So this is all about the forward guidance scenarios. The question is, should the Reserve Bank be providing forward guidance that is, telling us what they think is going to happen in the sort of medium term, shorter to medium term, particularly in a fluid environment, which our economic circumstances have clearly been over recent years. Because if they get it wrong, well, does it mean that those that have made decisions based on that forward guidance, and if that forward guidance is wrong, does it create, obvious issues for those that have taken decisions based on the Reserve Bank's predictions? And, obviously, it's not just, and this is the point, it's not just the recent history of the Reserve Bank. Governor Lowe has been pointed at the, predictions that interest rates would not rise until 2024. That was the statements that he was making and the bank was making quite consistently over a reasonable lengthy period of time recently. And of course, we know that because of inflation, which was generated through the COVID experience. So these things, we couldn't obviously predict.
Of course. But I mean, to back, most people would stick to their guns and say, based on the data at hand and the modelling, we had to make the decisions we made. Yet to stand up and say, I'm sorry I got it wrong, and I'm sorry if you're financially screwed right now based off me getting it wrong or us getting it wrong, it's almost saying, well, I didn't really use the data. We just had it through a data to dartboard and made some decisions. And they probably weren't timely and they probably weren't based on data, because now we're saying we don't stand by what we did.
Yeah, you're sort of jumping from the frying pan into the fryer, aren't you, Graeme?
I mean, people these days, we're in a woke society. I'd rather people just be transparent and honest than this, but it's almost just as bad at going, I'm wrong, sorry, guys.
And you're the Reserve Bank governor. You're in charge of monetary policy. It's such an important position for our economy. And, it's sort of deja vu all over again, but in reverse, because back in 2015, 16, 17, we had the Reserve Bank governor and the Reserve Bank consistently telling us that the next move in interest rates would be up. And based on those predictions, that forward guidance, of course, we had APRA, who are the bank regulators, decided during then strong market conditions that if interest rates were going to rise, we need to protect the market because we have a lot of investors active. And if interest rates rose, that might mean that investors were in trouble, might get into trouble. So therefore, they instructed the banks to reduce lending to investors. Now, as we know, the Reserve Bank got that one wrong again. In fact, interest rates didn't rise. They fell sharply. The outcome for that credit squeeze on investors, which really lasted for a number of years, has been that we've run out of rental properties as one of the consequences. So should the Reserve Bank be apologising for that forward guidance, which has resulted in a rental market where we don't have any rental properties to offer?
What I'd love somebody in the Reserve Bank or a policymaker to go, like overseas at the moment, because the servicing at 5 or 5.5%, they're pretending investors and mums and dads are borrowing at 8%, right? So they're putting that buffer on there. Yes. They go, well, at 7.5 or 8, you can't buy anything, and we're only going to pretend you're getting rent some of the time. Yet NAB actually came out and changed their policy last week to say, we're not going to pretend you're getting 60% rent because vacancies are so low and rates are so high. We will assume that you've got a 90% rental income. So NAB's come out first, good on them, by the way, and gone, we want to help the investor in the market and put roofs over heads, because we're seeing that there's really no vacancies anywhere. So we can accept more income, or we can assess it on the merits of the actual facts, if that makes sense. I mean, if policymakers were serious, wouldn't we come out and go, you know what? The vacancies are low in certain postcodes and areas, and use data like you provide to go, there is no vacancy in this area. There's a crisis. Rents have gone up 20%. Yeah. Let's actually put some policies in play for the banks to help stimulate housing supply. They never come up with that as a policymaker.
Yeah, look, I think there's a growing role for governments to really start looking closely at our banking sector and all the various mechanisms, that control it, and whether consumers are getting a good deal out of this. We certainly have shareholders of banks to think about as well. They need to maximise their profits. That's what your shareholders want you to do. But of course, there's only 4 banks, Graeme, and they have massive market power over a very important commodity, which is the provision of finance. So there needs to be some sense of responsibility to the consumer, that consumer rights are protected given their market power. And, we have, government bodies and quasi-government bodies that are supposed to be all about controlling competition in favour of the consumer, or certainly to protect the consumer. Well, come on, guys, do your job. We've now got the RBA governor apologising, and this is all interlinked with what's happening with the banks.
Well, usually when you apologise for making a mistake, you also do something to repair the mistake. So I wonder what the RBA is going to do to actually fix that.
Well, I think what they've said in their latest, and we're going to refer to their latest minutes, Graeme, but in another factor, but they've said that they're going to avoid that forward guidance from now on. So it's like taking your bat and ball and going home, isn't it? But they're going to avoid that forward guidance, and
so they're going to stop making predictions about the Australian housing economy. They're just going to act off the data.
They're just going to say up or down or sideways. That's it. 3 words, and that'll be all you hear from the Reserve Bank. What's happening now? But I'm being a little facetious there. But look, I think that it's about a balanced approach, and I think that if and consumers would have understood if the Reserve Bank had have given some clarity as to its forward guidance, as to the reasons behind it, and then you can quite clearly say, well, look, we thought interest rates wouldn't go up for a couple of years based on this, but who can predict COVID? Well, nobody predicted COVID. And who could predict the government's response to COVID, which was quite reasonable, and that was to throw money at the problem, and that throwing money at the problem would result in the sharpest inflation in decades, which nobody really predicted. So the Reserve Bank can say, well, look, we were just relying on the circumstances as they were, as well as, history, but these were quite unprecedented circumstances. So we got it wrong, and so did everybody else. So, and I think consumers would have said, yeah, that's fair enough. Nobody predicted COVID. Nobody predicted the inflation, what was going to happen. So, and I think that the point is that a lot of the, if I could say, narcs in the market have sort of, were caught wrong in terms of it, because they've all been predicting interest rates higher sooner rather than later. And a lot of that is the financial sector, because, of course, the financial sector benefits from higher interest rates, Graeme. And I think that there's a bit of punishment involved in that as well to some degree. But look, I think it's fine to give forward guidance as long as we do here, Graeme. As long as you are, you're not looking at 20 years' time, which is mission impossible, or even 2 years' time, which is mission impossible, because things change quickly and can change quickly, as we've seen. I think as long as it's in the sort of shorter term, and that you support that with evidence. If it's evidence-based research, then, if you're wrong, it's because the evidence was wrong, because things changed. And I think people accept we live in a changing world. We live in a changing economy. And, that we can't measure and model everything accurately because of change, So it was remarkable that the Reserve Bank governor came out and apologised. I think we need to, as you said, Graeme, governments need to have a real close look at the banking sector and the complete big picture in terms of monetary policy, its mechanisms, and, going forward, because it's just not a good look to have the head of the Reserve Bank apologising. No. Seriously,
I don't think you get any kudos for admitting you're wrong in this instance, considering what people are going through. So, but let's do what we usually do. You know what's better than being wrong? Being right. So let's go through the data, Doc, because you've got some good stuff this week, and it's been a while because I've been a bit ill. So apologies to all of our listeners tuning in, but we're back. And Doc's got some good data we're going to rip through now.
Yes, and as usual, we'll use evidence-based research to support what we say, Graeme, and I think that's why we have a reasonably good record going forward, and that good record's been reinforced over the spring selling season.
Well, we do like to be right, Doc. That's important.
Yeah, well, we've had some interesting data out recently on the economy, and we'll start with that just quickly. Of course, the economy has been the key to our revival, Graeme, because we have this remarkable boom time economy, lowest unemployment rates on record, certainly with the monthly data sets. We've got to go back to the early 70s to get these very low unemployment rates. We had just recently the capital city unemployment rates released, and these are just remarkable. Look at those numbers for our capital cities, Graeme. They're all in the threes. And Sydney's now the strongest economy in terms of the unemployment rate, down to 3%. Now, this is actually the lowest ever recorded for the Sydney market, Graeme, that 3% unemployment rate. Unemployment rates for capital cities only go back to the early 90s, so we can't go back with the national numbers that go back further than that, a lot further than that. But still, it just shows you, how strong our economies are. All our capital cities are, with Sydney leading the charge. And you can see they've basically halved over the last year, which is amazing. We were sort of thinking about those 5% results were okay a year ago and that they might move into the fours. Well, they've gone beyond the fours and they've hit the low threes. We might even get some twos happening here, Graeme. Oh, that would be really seriously head-spinning stuff. But nonetheless, these are great results. But look at these numbers, folks, because this is why our housing markets have shrugged off those higher rates, because basically everybody's got a job who wants a job.
Everyone's got a job. And, Doc, people still out there swinging, we're going to have a reset. Well, okay, the definition is 2 quarters of negative GDP that nobody even knows what that frickin' means anyway. But everyone's got a job.
Yeah, and wages are rising, Graeme. We saw wages. Wages are now up by 3.1% over the past year with the latest data, which is the highest rate we've had for some time. Our wages aren't rising as fast as the US and the UK, which are, nearly double that rate. But that's actually driving their problems with inflation. And the good news is that even though our wages aren't rising as fast as inflation, it's stopping us from fueling inflation because our wage-setting mechanisms are a lot steadier than those that the UK and the US have. We have those annual or even 2-yearly wage reviews and enterprise bargaining, so which means you've got to have a productivity measure to get a higher wage, or improvement to get a higher wage. So we are getting paid more, which is good, but we're not getting paid as much. That would push up inflation and would therefore mean higher interest rates going forward. So some good news there on the economy, Graeme, for our capital city markets. But people have a job who want a job. They're getting more money. So what do you do when you're feeling good about things? You go out and you buy your house, and that's what's happening. And that's what started to happen. So the fear of being involved might just transfer itself into the fear of missing out next year at some time, because
going from phobia to back to FOMO.
Yeah, no, that's right. Because a lot of those that have been sitting and waiting for some signs, well, I think they're getting those signs now, and we'll look at some of those signs of market improvement over November and into the spring selling season. So the other good news, believe it or not, was that we had the retail sales data out this week, Graeme, for October, which is out early. And we actually saw the first fall in retail sales, seasonally adjusted, over a month for nearly a year. This is the October data. The last time data fell was December last year, but that was, a lot of COVID issues then.
This is good news, Doc. I know people think, hang on, this is good news.
This is great news, mate, because this now gives the first sign for the Reserve Bank that the higher interest rates are starting to work. Correct. So they know they're starting to work. They can say, okay, we don't need to increase them anymore. This is a really good sign for the Reserve Bank that finally spending is starting to ease. It's still very high, Graeme. Let's not get silly about this. It's still very, very high. Just look at those numbers prior to COVID, how much higher it is. But, it's the first sign of an easing in the boom. And this is exactly what the Reserve Bank wants to see, because if we're spending less, it gives some relief to suppliers who have been, caught short with all this demand. And that's why we've had inflation rising, particularly for items such as household goods. But if we're seeing a reduction in spending, that's the first sign. And particularly the first sign the Reserve Bank needs to start thinking, okay, our policies are working. And that's the point that we're looking to see. Now, also some other good news for interest rates is the oil price, Graeme. And we've seen the oil price now under 80 cents, $80 with 80 cents.
80 cents?
A barrel. We'd be giving it away, wouldn't we? But yeah, US oil prices are now below $80 US a barrel. And you can see how much lower. That's nearly 50% lower than the peak earlier this year. And of course, that was a significant factor in driving inflation. So we may almost start getting a deflationary impact from if oil prices continue to fall as a result of negative oil prices.
So we've got retail spending falling.
Yes.
Oil prices fall. We are really getting some deflationary signals here.
Yeah, and that's great because we've still got 3% unemployment rates, mate. So it's not affecting the bread and butter measures of having a job and earning money and earning more money, which is what...
I tell you what, Doc, wouldn't it be great to think that Australia, the lucky nation, come out of this, the rate increases have been short, hard and fast. We've stopped spending. We've paused a little.
Yeah.
Money's still cheap compared to 2010, mind you, and it was 7.5%, 8%.
Yes.
But imagine if we can't, oil's got a bit cheaper. We've spent less. We're being a bit more sensible. We're not spending like drunken sailors. We're seeing unemployment rates in the low 3s, maybe even see a 2 for the first time ever.
Which is mind-blowing.
Mind-blowing. And a percentage of that 2% just don't want to work or can't work. So, Doc, I don't know. I'm getting a bit of the butterflies here. This feels like it could be okay next year.
Well, and I think that, the Reserve Bank's movements on interest rates recently are sort of signalling that, Graeme, because they only raised them by 0.25% in October and November following that surge in rates, 4-monthly surge of 0.5% each month. And as you said, the rates might even now be on, we can now talk about rates being on hold. And now in the latest minutes, this is what the Reserve Bank said. And I think this is an important statement that they made. And this was a bit of like on the one hand this, on the other hand this. So they sort of said on the one hand rates could go up, but they also said on the other hand, the board is prepared to keep rates unchanged for a period while it assesses the state of the economy and the inflation outlook. So it's thinking, okay, we might just take it easy for a while. We want to see, because interest rate policy tends to lag. It takes a while to see its impact either up or down, or whether either falling rates or raising rates. So it's actually put out there, it's clearly stated that it's prepared to keep rates on hold while it assesses what's happening. So it's an outside bet here, Graeme. So don't be putting any money on this. But maybe next week they might keep rates on hold, when they have their December.
Well, you wouldn't want to make this statement after and then say sorry and then go against this statement and say sorry.
No, we should give the poor guy a break, mate. He's getting bashed left, right and centre now. Gee whiz. So I'm just saying this is all part of that improved outlook. Now, I think that, and many are saying this now, that we may see rates peak in the mid-3s next year sometime, Graeme, perhaps earlier next year than predicted. So if we do get rates peaking in the mid-3s, 3.5%, 3.6% maybe as our peak. Now, that's you compare that to back in 2010 or 2010-11 when we were last increasing rates. Rates peaked at 4.75 then. So if we peak at 3.6, that's so much lower, of course, than that 4.75% that they peaked when we were last increasing rates. So again, that's all about that comparative advantage that we have in terms of interest rates, where they are now, where they have been previously. And, again, that's another factor that maybe has moderated the impact going forward. So we've got a lot of good news on interest rates, I think, Graeme. There's still a lot of, a lot of work to do here, and let's not get too over enthusiastic. But I think the trend is certainly improving in terms of seeing those rates peak lower and earlier than many have predicted. And that's reflecting some improved outlook on inflation. So we wait and see.
Watch this.
Let's have a look at the housing market, Graeme. We've done economics to death. So these are the latest monthly house prices that My Housing Market has released. These are asking prices for properties that are listed. So this is all the properties that are listed currently. And these are only established houses, Graeme. So we don't cover new houses because that can tend to reflect the sort of developer agenda rather than what's happening on the ground between buyers and sellers more specifically. So we look at established houses that are listed. These are listed prices. And over November, over the month, it was only the Sydney market that that fell away over the month, and just marginally by 0.8%. All our other capital cities, and this is for houses, increased marginally, with Perth, the most significant there, up by just 0.6%. So some gradual tickling upwards there in house asking prices for houses. And asking prices, Graeme, tend to be a more of a forward indicator of the general sales prices going forward. If we look at units, we can see Sydney units are up, and this is a more volatile market set, of course, Graeme, because we have fewer units, in the market. But Sydney unit prices up over the month by 2.4%, Adelaide up by 4.2%, Perth down by 0.2%. But these are smaller markets, the Adelaide and Perth markets, in terms of units. And when we look at the annual growth for units similar to houses, Brisbane and Adelaide leading the charge, and Perth, Sydney and Melbourne reasonably flat over the past year, but certainly starting to pick up now. So that's the latest monthly house prices, Graeme, and some positive news there, which I think will be reinforced when the other data modelers bring out their results for November. But of course, their sale prices, not asking prices. And as I mentioned, I'll just emphasise that this does tend to be a bit more of a forward indicator of what's happening in the market, and it does cover the full market. That's all properties listed for sale at the moment. So average days on market are also falling, Graeme. This is another sign that's correlating an improved price outcomes. So average days on market in Sydney and Melbourne are now below 30. So it's really been 6 months since we've seen that. So that's moving in the right direction. It means it's now not taking as long to sell your house as it was through the winter and early spring period. And Adelaide's still the market with the fastest selling houses. Now, auction markets, we always cover this on a week-to-week basis. Now, this is the icing on the cake, Graeme. Last weekend, of course, the weekend before, we had that amazing 70% clearance rate in Sydney, which was, we've been sort of threatening a 70%, Graeme, haven't we, in Sydney? But we actually got it 2 weeks ago, and it was from reasonable numbers. Now, last weekend, I guess we started to see the first signs of the market easing into the end of the year period. Sydney also hosted a big rise in auction numbers. So that probably also impacted the clearance rate in Sydney with a higher number of auctions, meaning that there were more properties to select from buyers, and that always puts downward pressure on clearance rates. The Melbourne market, another big day of auctions in Melbourne. Melbourne's been incredibly steady over the spring period, Graeme, really in those every weekend in those mid-60%. Brisbane picked up a little bit, but the Brisbane market has been volatile recently. Adelaide, again, it bounced back at the weekend, and Canberra was reasonably steady. So early signs there of that easing in clearance rates that we get from the seasonal effect from the end of the year. But now what we've done here, Graeme, let's have a look at the monthly auction results. This is really quite interesting. Over November, the Sydney market actually averaged or had the full clearance rate over November for weekend auctions in Sydney was 67.1%. That's a really great result, Graeme. And it's certainly, we have to go back to the stronger period in the market in April to get those sort of numbers. So a really good result there. But you can see the trend rising every month from July there, Graeme, upwards in Sydney. Sydney market, which is typically leads the country up and down, has certainly led its way out of spring. And this is a very good result for Sydney. Melbourne, as I said, down a little bit over November, but it's been very, very steady through the spring selling season.
They're both consistent and stable, Doc. I think that's the key. There's not these huge variations or discrepancies. They're both very stable.
And the Melbourne market, that's right. And the Melbourne market has risen similar to Sydney, not as quickly through the spring period from winter, and just eased off a little bit over November, but still, quite a solid result there. Quite a balanced market for Melbourne. So it's another positive story. Brisbane's up and down. We've seen that. It's not getting the same buyer surge from the Southerners that it had last year when its clearance rates were a lot higher. But these rates are reasonably typical for what we expect in the Brisbane auction market, which doesn't have the same strong auction culture as the other capital city markets. But nonetheless, the Brisbane market's had a remarkable period of growth And it's just now, over the shorter term, in my opinion, moving into pause mode. Adelaide down from those boom time results through early spring. But again, it's, we can't keep getting 80% plus clearance rates. No. It's just unsustainable. And the Canberra market, up until recently, has also shown, similar to Sydney, signs of a revival there. So that's it today, Graeme. I think that the data's positive for the economy. November has been, which is sort of the final month of our housing market for the full month. December, of course, will be affected because the market shuts down in a fortnight. We've only got those 2 weekends really left of auction activity. It'll be interesting to see what happens there, but we always see lower clearance rates through December because of that distractive effect of the coming holiday season. But I think our housing markets can be pretty happy, Graeme, with their results through spring. It's been a revival, no mistake there. It's not a surging revival. It's not something driven by sharply falling interest rates. It's just the market really responding to a very strong economy and also responding to, the undersupply of housing, which is chronic in this country. So despite interest rate increases, markets really decided, well, we're going to keep on keeping on. And I think the scene is set for next year to be a positive period. But we'll be interested next week to see what the Reserve Bank decides to do in terms of interest rates. So hang on to your hat for that one.
And I think, Doc, we might do a very detailed end-of-year wrap in mid-December for everyone to have a listen to and a watch while they're on holidays. And then we might even throw in some forecasts and predictions together for next year, for the new year, or early in the new year. We might do that for everyone.
Yeah, that's good. And we can maybe even look when we do our the year that was podcast. We can look at which areas in the major capitals have done the best as well.
Absolutely. Excitingly enough, Doc, we nearly are at the end of the year, and we're actually, you and I are quite positive, and we're not pessimists, we're not optimists, we're realists using the data you provide, but I think we're actually probably even better off than you and I have been, not spruiking, but validating all year. We're probably even stronger than we were suggesting we would be.
Well, that's, of course, Graeme, and given interest rates, how sharply they increased, you're always going to expect, particularly, that having an impact on confidence. But I think that buyers and sellers are starting to ignore all the doom and gloom and get on with life. And maybe they're just not, the clickbait's not getting clicked as much, and because there are other sources of information. But there's no doubt that this has been a reasonably active market through spring, almost across the board. And I don't think you and I have anything to apologise for, Graeme.
Absolutely not. We apologise for absolutely nothing, as Conor McGregor would say. No, I appreciate it, Doc, as always. It's good to catch up after a few weeks away while I was ill. And ladies and gentlemen, next week, we'll see what the Reserve Bank has to say. And the following week, Doc and I will give you an end-of-year wrap that you can tune into when you get some downtime with the family in the festive season.
And look at the top-performing regions, Graeme. We can
absolutely looking forward to it. Thanks, Doc.
Good on you, mate. Great to chat and good to see you up and about again.
That's it. Thank you. We're getting there. Thanks, Doc. So if you need help or you need to find out more, go to money-mentor.com.au and use the discount code podcast1500. So instead of $19.97 for a weekend full of experts, economists, financial planners, accountants, asset finance, you name it, then go to money-mentor.com.au, use the discount code podcast1500 and it'll drop it from $19.97 to just $4.97. That's $19.97 to just $4.97.